This weekend, a 25-year-old is getting married. 3 days ago, he was one of the most watched investors on Earth. A German prodigy, Columbia valedictorian at 19, a fund that turned every dollar into 11 in under 2 years. And then in the span of about 72 hours between an investor letter and a single enormous phone call, most of it was gone. $45 billion at its peak. By the time the buyers were done, roughly 10. This isn't a story about being wrong. That's the strange part. He wasn't wrong. The machines he bet on are still winning. He was just early, with someone else's money and far too much of it. To understand the collapse, you have to understand the reputation, because the reputation is what made the leverage possible. Leopold Aschenbrenner graduated top of his class at Columbia at 19. He landed on OpenAI's super alignment team, the group tasked with keeping a future superintelligence from slipping the leash. In 2024, he left. OpenAI said he was fired over an improper disclosure. He said he had shared a mostly non-confidential planning document for feedback, and that the real friction was over security warnings he had raised. Both sides still tell it differently. What he did next made him famous. He published a long essay titled Situational Awareness, arguing that artificial general intelligence was arriving between 2027 and 2030, and that almost nobody was pricing it in. Then he did something most essayists never do. He put his money where his thesis was. He launched a hedge fund, same name, and he told people he had poured nearly his entire net worth into it. The thesis was simple. If the world is about to be rebuilt around AI, buy the picks and shovels. The chips, the power, the data centers, the names nobody else had the conviction to size up. For a while, it worked better than anyone's wildest model. Here's where I want to slow down, because this is the part most coverage skips, and it's the part that actually matters. A 1,000% return doesn't come from being right. It comes from being right with leverage. Aschenbrenner didn't just buy AI infrastructure, he borrowed to buy more of it. His public filings showed a concentrated book, a barbell. On one side, put options on AI chips, a hedge. On the other, heavily sized long bets on the messier, higher beta corners of the trade. SK Hynix, Micron, SanDisk, Nebius, and others. Now, if you've ever traded on margin, you know the trap already. Leverage is a lever in both directions. It multiplies the wins on the way up, and it multiplies the losses on the way down. But it does one more thing that's easy to forget when you're up 400%. It hands the timing of your exit to somebody else. When you own a stock outright, you decide when to sell. When you own it with borrowed money, your broker decides. The moment your collateral drops below a line, they call the loan. Not when you think the thesis is wrong, when the price moves against you. Those are not the same thing, and the gap between them is where funds die. By mid-year, Aschenbrenner was reportedly UP 439% net of fees. The fund had swelled toward $45 billion. He was on paper one of the youngest billionaires alive. Every ingredient for the fire was now in place. All it needed was a spark. July. AI infrastructure stocks started sliding. Nothing catastrophic at first, a rotation, a wobble. But when you're levered and concentrated, you don't get to sit through a wobble. Several of his biggest positions fell 30% or more in a matter of weeks. The collateral shrank. The margin lines got close. On Friday, July 24th, the fund sent its investors a letter. It described the route as a buying opportunity and pointed to a possible Anthropic IPO as the next catalyst. Steady hands. Hold the line. But here's the brutal mechanic of a hedge fund in trouble. The moment you tell people you're bleeding, the information leaks, and the market is full of sharks who can smell it. Other funds knew roughly what he owned. They knew he was levered. They knew forced selling was coming. So they got in front of it, pressing his positions lower, tightening the noose, turning a bad month into a death spiral. The selling wasn't really about whether AI would win anymore. It had become purely mechanical. Price down, collateral down, margin call, forced sale, price down further. A machine eating itself. His prime brokers, Bank of America, Goldman Sachs, and JP Morgan, were scrambling to raise the cash to meet the calls. there wasn't enough. So on Thursday, it ended the way these things end. Not with a slow unwind, with one enormous block trade. The entire public book, the longs, the shorts, everything, sold in a single transaction to a single buyer. Ken Griffin's Citadel stepped in and bought the bulk of the public equity portfolio. A fund that had touched $45 billion saw its assets cut to around 10, more than halved in a matter of weeks. And then came the twist that makes this story sting. The instant the liquidation news hit, the same battered AI stocks that had been dragged down for weeks ripped higher, some up 15, 20, 25% in a single session. Because the selling had never been about the fundamentals. Microsoft had just printed its best earnings in years, with Azure growing 43%. The demand for AI compute was surging, not fading. The weakness was one forced seller dumping into a market that actually wanted the shares. He was right about the destination. He just got margin called off the road before he got there. The firm survives in a smaller form. It still holds a large private stake in Anthropic and plans to run on as a private investment firm. But the machine that made him famous is gone. So what actually killed situational awareness? Not the thesis. Pull the file on every great blowup, and you find the same 3 fingerprints: a genuinely good idea, spectacular returns, and leverage, stacked on concentration. Long-term capital management had Nobel laureates and a brilliant model, and blew up on leverage in 1998. Archegos had real conviction in real companies, and detonated on hidden leverage in 2021. Amaranth. The list goes on. Each one started with an edge and ended with a loan. Situational awareness fits the pattern so cleanly, it's almost eerie. The difference is speed. This one went from billionaire to fire sale in about the time it takes to plan a wedding. And there's a darker footnote. Before the fund, Aschenbrenner sat on the small team running the FTX Future Fund, Sam Bankman-Fried's philanthropy vehicle. That blew up too in 2022. Twice now, he's been near the center of a spectacular collapse. Both times, brilliant. Both times, early. Both times undone not by the idea, but by the structure built on top of it. Here's the uncomfortable takeaway, and it's older than any of these funds. The market can stay irrational longer than you can stay solvent. But the sharper version is this: being right is worthless if your position can't survive the path to being proven right. Leverage doesn't just raise your risk, it steals your time. And time is the one thing a correct but early bet needs most. Aschenbrenner may yet be proven right about AI. 2027 is still ahead of us. He just won't be holding the position when it happens.